Hello, my people. Glad to be here again. It's my privilege standing before you. In the last video, I started the subtopic under the financial leverage and theory of capital structure, where I started to treat the theories of capital structure. The last video, I spoke about the traditional theory of capital structure, in which I said majorly I'm going to look at traditional theory and the M&M theory of capital structure. So other theories of capital structure which we have are the net income approach. Also we have the net operating income approach. So now on the M&M theory of capital structure, the M&M theory challenged the traditional view as to the effect of leverage on the cost of capital. The M&M theory is ahead of what is a modification. It's taken a step ahead of the traditional theory. It challenged the traditional theory as to the effect of leverage on the company cost of capital. The M&M theory is a theory by the M is what? Modigliani, and the second M is what? Is Miller. So these two people come together to do what? To postulate this theory. This theory was postulated in the year 1958, which challenged the traditional view or as to the effect of leverage on the company's cost of capital. So this theory of M&M, they developed a behavioral justification support for the net operating income approach. So let me just quickly talk about that, the net income approach. What net operating income approach rather? Net operating income approach. What is what is the net operating income approach say? So the net operating income approach theory of capital structure holds that financial leverage or capital structure do not affect the market value of the firm or the weighted average cost of capital. So the net operating income approach holds that the financial leverage or capital structure do not affect the market value of the firm or the weighted average cost of capital. That is exactly what the net operating income approach stated, which is against what the traditional theory approach stated. The traditional theory approach stated that using a debt finance, you are going to get, in the capital structure of the company, there will be a limit, there will be an optimal level in which the company should not go further. If the company goes further above that minimum level, the optimal level, the company will tend to do what? To experience devaluation. While the net operating income approach stated that there's no mix, there's no level of structure, no level of no optimal level in the short term. And that is exactly what the M&M approach is laying emphasis on. So the M&M approach argued that without tax, the cost of capital and market value of the firm remain constant throughout all level of leverage. And this is exactly what is meant by saying that this theory challenge the traditional view. The traditional view, which I treated in the last video, stated that there is an optimal level of debt finance in the capital structure. So M&M theory is challenged the traditional view. They are stating that it now argues that without tax, Without taxation, without taxes, the cost of capital and market value of the firm remain constant throughout all degrees of leverage. So all degrees of leverage means that what if debt capital is what even increased more than the current state. Without tax, therefore, the value of the company will still what market value of the company will still remain constant. This is against what that's why we said is what is against the traditional theory. That's why we said it's challenging the traditional theory. So M&M came up with what? With three propositions. The first one is that a company cannot change the total value of a security. The company's value is determined by its real assets, not by the security it uses. That is to say, a company cannot change the total value of the company, VO, the total value of the company. It cannot be changed. Now, the real value of the company is determined by the real assets, not by the security it uses. The real assets of the company. That is what you can tend to do or to talk about the value of the company. That is not by the security it uses. Also, another proposition is that the expected rate of return on the equity of a jet company increases in proportion to debt-equity ratio expressed in market value. That the expected rate of return on equity of a jet company increases in proportion to debt-equity ratio expressed in market value. This is what I'm saying here. At a point where additional debt is increased into the capital structure of the company, the equity holders will also request for a corresponding increase, a proportional increase in proportion to debt equity, a proportional increase of their return due to the fact that additional debt has been brought into the company, not because we have additional debt, but because the additional debt brought into the company will come with what? With a corresponding increase in what? In the value of the company. That is to say, investing this money, this equity, this fund raised through debt is going to bring in more return for the company. By implication, therefore, the equity holders will also request for what? For a corresponding increase in what? In their equity, in their to return on equity. So that is what this proposition is saying here. So the third one says what? This provides a rule for optimal investment policy by the company. The cut-off point for investment in the company will, in all cases, be the WACC and will be completely unaffected by the type of security used to finance the investment. That is to say, what I'm saying here is this: that the cut-off point will always be the WACC. And WACC is a combination of what? Of all weighted average cost of capital of all the funds used by the company in its capital structure, equity, preference share, and debt. So the aggregate of what? The weighted average of all this cost of capital is what we call WACC, which will in turn be the mixture of everything. That is what will be the cut-off point for investment. So by this, therefore, M&M totally challenge what M&M theory challenge the traditional approach or the traditional theory of capital structure. So note that without tax, the value of the company will still remain the same, irrespective of the level of gearing. Or with tax, that is by implication that with tax, so it will not remain the same. Which to some extent is still looking up to the traditional approach. Anyway, at this point, we're going to move further on what? We're going to dwell more on what? On the M&M theory rather, M&M theory. Because we're going to look at the formula for computing what? The cost of equity of a jet company. A jet company is a company that has an element of debt in its capital structure. Cost of equity of a jet company, the weighted average cost of capital of a jet company with and without tax. In the next video, we're going to examine other forms, other variants of what of M&M, looking at the formulas to compute cost of equity and weighted average cost of capital with tax and without tax. Thanks for watching and stay tuned and watch the next video. Please, if you have not subscribed to this YouTube channel, why not? It costs you nothing. Kindly click on the subscribe button, the red button you are seeing with description subscribe. Click on the button. And also like the video, give us thumb up. Like the video, share the video, invite your friends, students, tertiary institution students, financial managers, financial planners, entrepreneurs. All this thing I'm talking about is going to help them a lot in planning their finances, in knowing how to do how to structure, how to put together their financial resources, how to source for the fund, and the level at which they should introduce debt, the level of debt, and on like that. It's going to help them a lot. So till I see you in the next video, where I'll be talking about the M&M theory with and without tax, giving the formula to use in computing the cost of capital, the cost of equity of a jet company and that of a jet company, the weighted average cost of capital of a jet company and that of a jet company. Thank you for watching.